Your credit card is not a shortcut to freedom. It is a lever that can either build your future or quietly turn your life into debt slavery. And here is the part nobody wants to admit out loud. In 2026, the easiest way to fall behind is not overspending. It is getting denied when you actually need money. Not everyone loses because they are reckless. Some people lose because they are invisible to the banking system. This is not financial advice. This is financial education, and I am going to walk you through the mechanism that most people never learn until it is too late. If you live in the United States, the United Kingdom, Canada, Australia, anywhere real wages are lagging behind rent and groceries, you are already living inside the trap. Inflation may have cooled on paper, but purchasing power still took a hit that your paycheck has never fully recovered from. Meanwhile, the top 1% keep buying more assets while your options shrink, and AI is eating entire categories of middle-class jobs, replacing them with cheaper labor and automated workflows. So the question in 2026 is brutal. How do you get access to capital when your income is under pressure and your housing cost is permanent? You are going to hear a story about why debt does not automatically equal disaster. Then you are going to learn why credit history matters more than people think. After that, you will see how banks decide who gets approved and who gets treated like a risk. Then we will connect it to the real world you are already in, including housing affordability, retirement stress, and the credit tightening cycle that follows rate decisions by central banks like the Federal Reserve. And at the end, you will get one actionable mindset shift you can apply immediately, even if you never touch a credit card again. First, let me destroy one common belief. The belief is simple. If credit cards exist, then only irresponsible people use them. If you have one, you are not rich. If you do not have one, you must be poor. That belief is emotionally satisfying because it lets people sort themselves into a tribe. Rich people are supposed to be smarter and cautious. Poor people are supposed to be reckless. But reality is uglier and more mechanical. Credit cards are not a moral test. They are a gatekeeping system for future borrowing. And in 2026, borrowing is not optional. You do not just borrow to buy luxury cars. You borrow to bridge gaps caused by disrupted employment, rising insurance costs, and the gap between wage growth and housing growth. You borrow to survive climate shocks. You borrow because your employer uses AI to cut staff and restructure, and suddenly your monthly income feels like it vanished overnight. You borrow because your landlord can raise rent again, and because groceries keep taking bigger bites than your salary does. Now picture your life as a series of moments where you need liquidity. A car repair, a medical bill, a job switch because AI replaced your role, a move because your rent went up again. A down payment that keeps slipping away because home prices rose faster than wages. Each time you need money, you are not just asking for cash, you are asking for trust. Here is where credit cards come in. One person I know, a friend from my past, told me he would never get a credit card. He said it like he was protecting his dignity, like he was refusing temptation. He said he did not want the bank's manipulation. He believed credit cards were built to lure you into borrowing, then charge you interest, then make you their customer for life. And I understood why he felt that fear. His parents warned him too, and he probably saw the same news stories that everyone has seen. People rolling one card balance to another, paying minimums, interest stacking up. Then one missed payment, one late fee, one emergency bill, and the whole structure collapses. Bankruptcy, eviction, calls from collectors, the kind of stress that turns a person into a shell. Then he said something that sounded like a conspiracy, but it was actually a business lesson dressed as anger. He said credit cards are an invention that allows banks to become your creditor without you understanding the contract you signed. He said you work first, then your wages flow back to the institution as repayment. He said the bank does not need to clock in. You do. That is true. Banks do profit when you carry balances. Banks do profit from utilization. Banks do profit from fees. But the key missing piece is this: the bank's profit does not determine whether you get trapped. Your decision and your structure determine that. Debt is not automatically poison. Debt is a tool. Poison is using the tool in the wrong direction, at the wrong time, for the wrong purpose, with the wrong understanding of the risks. And that is why his logic was dangerous. It sounded smart because it matched his fear, but it also convinced him that not getting a card equals being safe. That is where people get robbed without even realizing it. Because in modern economies, access to capital is not a right, it is a classification. If you never build credit history, you do not just miss out on convenience. You miss out on approvals later. You miss out on better rates. You miss out on higher limits. You miss out on the ability to move quickly when an opportunity appears or when an emergency hits. And now we need to get more specific, because vague moral advice does not help you in 2026. Let's talk about one mechanism that should make you uncomfortable. Many people think companies that borrow a lot will collapse. They imagine an accounting cliff. Like they look at a balance sheet and see a mountain of liabilities and assume the sky will fall. But I want you to watch the trick. Some of the largest financial institutions borrow because they can borrow cheaply, then they deploy that money into returns that exceed their cost of capital. Borrowing itself is not the disaster. The disaster is borrowing without a plan, borrowing without assets that produce income, borrowing without an exit timeline. There is a well-known global pattern. Some massive companies carry liabilities that look terrifying at first glance, while their equity remains resilient. Their survival is not because they are better than everyone else. Their survival is because the debt is structured and because their business generates cash flows that keep them solvent. This is basic corporate finance. Leverage can amplify outcomes. It can also amplify risk, but it is not automatically fatal. So if borrowing can be normal for institutions, why does it feel like borrowing is always a trap for individuals? Because individuals are rarely given the full playbook. You are told to avoid interest like it is a demon, but nobody tells you the real difference between interest as a cost and interest as a price of leverage. Interest is not always the villain. Sometimes interest is the fee you pay to use someone else's capital long enough to generate returns. Sometimes interest is the rent you pay for a resource you cannot afford to buy outright today. If you understand the timing, the risk, and the cash flow, interest becomes a tool. If you do not, interest becomes a spiral. And here is where we pull the story tight, because stories reveal patterns. Imagine two people, Nam and Min. Min has a hen. Nam wants the hen temporarily. Min says no because his wife just had a baby, and they need the eggs, so Nam is not getting what he wants. Then Min remembers something in his safe, 10 gold coins. Min takes those 10 coins, goes to the market, and trades them for a hen. He gives Nam the hen. Nam takes the hen home and begins to raise it. The hen lays eggs. The eggs hatch. Over time, the herd grows. Years pass. Eventually, Nam remembers the original deal. He realizes that the hen came from 10 gold coins that Min provided. So Nam goes to the market, sells a female hen, and gets 10 gold coins back. Then Nam returns to Min and says, "Thank you, you gave me 10 coins to trade for a hen, and now I grew the hens. I am ready to pay you back." But Min is not just grateful. Min is thinking like a creditor. If you got a business outcome from his capital, should you not return more than the principal? Should you not pay for the opportunity? Nam thinks Min is greedy. He thinks 10 coins back is enough. In his mind, interest feels like punishment for taking advantage of luck. But from Min's perspective, the 10 coins did not just buy a hen. The 10 coins bought time and bought risk, and Min should be compensated for both. Now translate that to credit cards in 2026. Credit cards are not evil. They are a bridge between you and capital. If you use that bridge to create value, then paying interest or paying fees for the privilege of leverage becomes rational. If you use that bridge to fund lifestyle spending, then yes, you are doing the Nam thing. You are growing debt without growing productive assets. You are trying to get the benefit of leverage while refusing the cost of capital. And here is the next uncomfortable question. If you already know you are the Nam type, why would you pretend a credit card is a magic shield? It is not a shield, it is a magnifier. It will magnify whatever behavior you bring to it. Now, I promised you real stakes. So let's talk about the most brutal modern failure mode, credit invisibility. In your world, housing is the biggest wealth generator on the planet for regular people. But in the last decade, housing detached from wages in the United States, the United Kingdom, Canada, and Australia. Home prices jumped, and even when inflation came down, wages did not catch up. Many people have started treating renting like an endless sentence, and in many cities, insurance costs are rising fast because climate-driven disasters hit more frequently. That changes underwriting, that changes premiums, that changes mortgages, that changes affordability. Now consider what happens when you finally try to buy a home. Picture yourself seeing a property. You estimate a purchase price of around $10 million in local terms, or 10 times 10,000, whatever fits your market. You scrape together a deposit, you negotiate, you prepare paperwork, you show up to the bank. You are confident that because your income is steady, your monthly payments are manageable, and you have savings for down payment and closing costs. Approval is basically a formality. Then the bank says no, or it says smaller. Maybe they offer you 5 million instead of 7. Maybe they require a larger down payment. Maybe they ask for different documentation. Maybe they say your credit file is too thin or too risky. And you realize the worst thing in the world is not that your dreams are hard, it is that your dreams depend on trust you never built. You planned for one financing structure, but the bank approved another one. Now you have a gap. If you cannot cover that gap, you lose the deposit. In a hot market, losing a deposit means you lose your chance and you lose time. And time matters because the price keeps moving while your capital sits still. This is not hypothetical. According to Federal Reserve data and multiple consumer finance studies, credit score and credit history influence loan terms, and thin files are treated as higher risk. In other words, if you never built a credit profile, you are not just missing a benefit, you are taking on a real, cash-level disadvantage. And this is where your anger should show up, because nobody told you the hidden tax of being credit invisible. Some people say, I never wanted debt, but debt is not a single thing.
Debt is a classification. You have a debt relationship with every bill collector, every landlord, every insurer, every telecom account. The only difference is whether it is structured in a way banks respect. And banks respect behavior, they respect consistency, they respect the pattern of repayments, they respect utilization, they respect whether you pay on time. So now we reach the core. Why should someone consider using a credit card responsibly in 2026? Because credit history is leverage, and leverage is the currency that determines whether your future is open or closed. If you cannot borrow, you cannot buy the asset. If you cannot buy the asset, you cannot escape the rent trap. If you cannot escape the rent trap, AI-disrupted income has a smaller chance of stabilizing. If your retirement plan is already crumbling under underfunded pensions and delayed Social Security, you cannot afford to be locked out of financing at the exact moment you need it. In the United States, retirement age has effectively been pushed higher through policy changes and delayed claiming patterns. Social Security faces long-term funding pressures.
In the United Kingdom, pension schemes face investment and longevity risks. In Canada and Australia, retirement is already a struggle for many who do not have employer plans or who do not have assets to generate passive income. And you may say, I am not planning to buy right now. That is a comforting lie. The window for financial failure rarely announces itself. It arrives with an emergency. It arrives with a job loss due to AI automation. It arrives with a climate disaster. It arrives with a health issue. And every time it arrives, you either have access to capital or you do not. So let's get practical. You may have heard people say, credit cards are just for spending. That is the default narrative the system wants you to adopt, because it turns the card into a temptation machine. The bank wants you to experience the card as a consumer product, not as a credit instrument. But you can use a credit card as a credit-building tool. The mechanism is simple. You borrow a small amount. You repay quickly. You keep your repayment behavior clean. You avoid carrying high balances. You create a history of reliability. That does not mean you are gambling. It means you are training your profile to look low risk. In the same way you train a muscle, you train your credit report. And in 2026, a trained credit profile is not just about scoring points. It determines interest rates, approval thresholds, and whether you are offered better terms. Now let's talk about something people rarely connect: the Federal Reserve and everyday purchasing power. When the Fed raises interest rates, the cost of borrowing increases across the economy. Mortgage rates rise, credit card APR rises, auto loan rates rise, small business lending becomes tighter, banks become more selective. The same pattern repeats: credit becomes expensive and approvals become stricter. When the Fed cuts rates, people celebrate like the world is fixed, but many times inflation damage remains. Real wages do not leap back, and even when inflation cools, housing prices do not instantly fall to restore affordability. So people feel trapped. They spend more on rent and essentials, and they pay more for borrowing if they have to use credit. So if you are credit invisible going into that tightening cycle, you get squeezed twice, once by higher rates, once by denial or worse terms. And that is how the system keeps transferring wealth upward while you keep surviving month to month. Now, I am going to address the counter-argument head-on. But I do not want interest. I do not want debt. You are allowed to avoid carrying balances. Responsible use is not the same as living on minimum payments. It is not the same as rolling debt forward indefinitely. Responsible use is structured repayment, not escape from repayment. And now I want to connect this to AI, because AI is the job killer that makes emergency borrowing more likely. In 2020, people were told to learn to code. In 2026, that advice looks naive because AI writes code faster than many entry-level developers can. Automation replaced repetitive tasks across finance support, customer service, basic marketing production, and data analysis. Some workers transitioned, many did not. Many lost income or were forced into lower-paying roles. When your job is replaced, your budget becomes fragile. You stop saving at the moment you need to save the most. You begin paying from reserves. Reserves drain, and then you need a bridge.
In a world where housing is expensive and insurance markets are tightening due to climate losses, you do not just need money. You need money you can access quickly, so your credit profile is not an abstract number, it is a backup plan. But the system still does not tell you the hidden truth. Credit building is not about becoming reckless, it is about becoming eligible. Eligibility is everything when banks get nervous. Banks do not approve people randomly. They look at two categories of risk. First, credit risk. Can you repay? Do you have assets or income stability? How much do you already owe? How do you behave? Do you pay on time? Second, purpose risk. What is the money for? Banks treat different uses differently because different uses create different likelihood of loss. That is why mortgage loans are typically priced lower than consumer loans. Banks view homes as collateral that can be recovered if things go wrong. They can seize and sell. They cannot seize groceries. They cannot seize an impulse purchase. They cannot seize entertainment. So if you are building a long-term plan, you want your credit behavior to align with the kinds of borrowing you will likely need. A home purchase, a business investment, a bridge to protect your cash flow while you pivot jobs or launch a side company. Now, let me tell you another micro story, because I want this to land in your bones, not just your brain. Imagine a nurse named David in his early 30s. He works nights. He likes stability. He does not overspend. He rents a small apartment. Then one year his rent rises sharply because the local market tightens. Another year his city experiences a heat wave that forces insurance changes. His premiums rise. He starts relying on credit cards for small gaps, but he refuses to carry balances. He pays them off every month. He also avoids applying for loans because he believes loans are a trap, so he never builds much history beyond that card. He has a thin file. He thinks that is fine because his behavior is clean, but when he finally wants to buy a condo, his thin history triggers a manual review. The bank says the profile does not prove repayment capacity. They offer him less than expected. The down payment requirement increases. The deal falls apart. His deposit is at risk because closing timelines are strict. David does not fail because he is lazy. He fails because the system cannot measure him. His goodness never gets translated into eligibility, and now he is stuck paying rent again while AI reshuffles his workplace schedule. The window closed, not because he did something wrong, but because he did not build the credential early enough. That is the cold truth. You do not just need to be responsible. You need to be legible to the institution that controls your access to capital. And that brings us to an uncomfortable escalation. The people you see on social media selling passive income and financial freedom often skip the boring truth. Financial freedom is mostly access, not inspiration. It is financing structures, not motivation quotes. Most creators make $0 from content. They sell the illusion of wealth while your real life gets more expensive. Meanwhile, institutional players treat you like raw material for profits. In crypto, for example, the story used to be freedom from banks. In 2026, regulation and institutional involvement have shifted control. More crypto is held by institutions and banks than by retail investors. So when people say banks are the enemy, you should look at where the actual control sits. It rarely sits where the marketing promises. Back to credit cards. The marketing around credit is either fear or fantasy. Fear says, never touch credit. Fantasy says, always revolve and get rewards. Both are incomplete. The correct approach is strategic. It is about building credit without building chaos. That means you use the card like a tool for cash flow timing and